Today, I want to go through Meta's Q1 2026 earnings because this was actually a really interesting quarter. On the surface, the numbers were very strong. Revenue grew 33%, operating income grew 30%, margins were still above 40%. The ad business looked extremely healthy, but the stock reaction was more mixed, and the reason is pretty simple. Investors are no longer asking, is Meta a great business? I think most people already know the answer is yes. The real question now is, how much is Meta going to spend on AI, and will that spending actually produce enough return for shareholders? That is the entire debate around Meta right now, because this quarter showed two things at the same time. One, the core business is still an absolute machine, and two, Meta is becoming a much more capital-intensive business than it used to be. So let's walk through the quarter and what actually matters. Meta's revenue came in at $56.31 billion, up 33% year-over-year. For a company this large, that is a very strong growth number, and even on a constant currency basis, revenue was still up 29%, so this was not just a currency benefit. Advertising revenue was $55.2 billion, also up 33%. So even though Meta is talking a lot about AI, reality labs, the metaverse, business messaging, and all these future opportunities, the money machine is still advertising. And honestly, the ad business looked really strong. Ad impressions were up 19%, and average price per ad was up 12%. That combination is important, because sometimes a company can grow ad impressions by showing more ads. But if pricing falls, that tells you the extra ad inventory might not be very valuable. Here, Meta grew impressions and pricing at the same time. So they are showing more ads, but advertisers are also paying more on average for those ads. That usually points to strong demand, better targeting, better ad performance, or better monetization. And this is where the AI story starts to matter. The way I look at this is, investors need to see real evidence that all this AI investment is improving the core business, and in Q1, you can make the case that it is showing up in the numbers. Meta's recommendation systems, ranking models, ad targeting, and automation tools all seem to be helping the platform monetize better. Now, does that fully justify more than $100 billion of annual capex? That's a different question, but the ad numbers were definitely strong. Meta's family daily active people reached 3.56 billion, up 4% year-over-year. That is already an enormous user base, so 4% growth at that scale is still meaningful. There was a slight sequential decline because of disruptions in Iran and Russia, but overall, the user base remains massive. And when you combine 3.56 billion daily active people with rising impressions and rising ad prices, you can see why this business is so powerful. This is still one of the most dominant advertising platforms in the world. Now, on profitability, Meta generated $22.87 billion of operating income, up 30% year-over-year. Operating margin was 41%, which was basically flat from last year. And to me, that is one of the most impressive parts of the quarter, because Meta is spending aggressively on AI, infrastructure, and R&D, but the company is still producing 41% operating margins. Most companies would love to have that kind of margin in a normal environment. Meta is doing it while investing heavily. That said, expenses are definitely rising. Costs and expenses were $33.44 billion, up 35% year-over-year. So expenses grew faster than revenue. Cost of revenue was $10.22 billion, which still implies a gross margin around 82%. That's extremely high, but R&D spending jumped to $17.70 billion, up from $12.15 billion a year ago. So when people say Meta is spending a lot on AI, this is where you can see it. The company is hiring, building, investing, and putting a lot of money into infrastructure and research. Now, net income came in at $26.77 billion, up 61%, and diluted EPS was $10.44, up 62%. But we have to be careful with that number. Meta had an $8.03 billion tax benefit this quarter. Management said that, excluding that tax benefit, EPS would have been $3.13 lower, so instead of $10.44, adjusted for that tax item, EPS would have been about $7.31. That is still a very strong number, but you definitely do not want to just annualize the reported EPS and pretend that's normal earnings power. That would make the quarter look better than it really was. So the cleaner takeaway is this: earnings were strong, but reported net income was boosted by a one-time tax benefit. Now let's talk about free cash flow, because this is where the story gets more complicated. Operating cash flow was $32.23 billion, up 34%. That is excellent. The core business is still printing cash, but free cash flow was $12.39 billion, up only 20%, because capex is rising so quickly. Capex including finance lease payments was $19.84 billion, up from $13.69 billion last year. That's a 45% increase, and this is the biggest concern for investors. Meta is still extremely profitable, but the business is no longer as asset-light as it used to be. Historically, one of the best things about Meta was that it had this beautiful combination of scale, high margins, and strong free cash flow. Now, it still has scale, it still has high margins, it still has strong cash generation, but AI infrastructure means data centers, chips, servers, networking equipment, energy, and long-term capacity planning. That takes a lot of capital. And Meta raised its 2026 capex guidance to $125 billion to $145 billion, up from the prior range of $115 billion to $135 billion. Management said the increase was driven by higher component pricing and additional data center costs to support future capacity. So this is not a small adjustment. Meta is basically telling investors, we are going to spend even more than expected, and that is why the stock fell after earnings, even though the quarter itself was strong. The market is not doubting whether Meta can grow today. The market is questioning whether the AI spending will generate enough incremental revenue and free cash flow in the future. And honestly, I think that is the right debate to have. Because just because a company can afford to spend aggressively does not automatically mean the spending creates shareholder value. Meta has a very strong balance sheet. They ended the quarter with $81.18 billion in cash equivalents, and marketable securities, and $58.75 billion of long-term debt. So, financially, they can handle this. The balance sheet is not the issue. The issue is capital allocation. If Meta spends $125 billion or more in capex in 2026, investors need to see that money translate into something real. Better ad targeting, higher engagement, better ad pricing, more automation for advertisers, more business messaging revenue, maybe new AI products over time. But if spending stays high and free cash flow growth lags, then the valuation becomes harder to justify. Now, the family of apps business is still the profit engine. Family of apps revenue was $55.91 billion, up from $41.90 billion last year. Segment operating income was $26.90 billion, up from $21.77 billion. That means the family of apps operating margin was around 48%. That is incredible. Facebook, Instagram, WhatsApp, Messenger, Reels, and the overall ad ecosystem are still doing the heavy lifting. This segment alone produced almost $27 billion of operating income in one quarter. That gives Meta a lot of flexibility. It can fund AI. It can fund Reality Labs. It can invest in infrastructure. It can absorb regulatory costs. It can potentially buy back stock in the future. But the flip side is that Reality Labs is still a major drag. Reality Labs' revenue was $402 million, slightly down from $412 million last year. Operating loss was $4.3 billion. Losses improved slightly from the $4.21 billion loss last year, but this is still a business losing about $4 billion in one quarter. So when you look at Meta as a whole, you have this incredibly profitable family of apps business, and then you have Reality Labs and AI infrastructure absorbing a huge amount of investment. Reality Labs might eventually create value in AR, VR, wearables, or spatial computing. But right now, from a financial perspective, it is still consuming billions. And that matters because investors are already being asked to underwrite a massive AI investment cycle. If Reality Labs' losses remain high on top of that, then the total investment burden becomes heavier. Now, let's talk valuation. The current price used in the analysis is around $669 per share, with a market cap around $1.7 trillion. The valuation data showed a trailing PE somewhere in the mid to high 20s, depending on the provider, and a forward PE around 22 to 23 times earnings. Price to sales was around 8 times. So is Meta cheap? I would not call it obviously cheap, but I also would not call it crazy expensive given the quality of the business. At around 22 to 23 times forward earnings, Meta looks reasonable if you believe the company can continue growing revenue at a healthy rate, maintain strong margins, and eventually turn AI spending into better monetization. The problem is that free cash flow is getting less clean because capex is so elevated, so earnings multiples are useful, but they do not tell the full story. Investors also need to look at operating income, free cash flow after capex, and normalized earnings power excluding the tax benefit. My view from the numbers is that Meta looks fairly valued to modestly undervalued. Not a screaming bargain, but not overpriced either, assuming AI investment actually pays off. And that assumption is the key. For the 5-year outlook, the base case in the analysis assumes Meta's revenue grows from around $245 to $250 billion in 2026 to about $385 billion in 2030. That would be roughly a 9% to 10% revenue CAGR over 5 years. The base case assumes a normalized net margin of 31%, net income of about $119 billion, diluted shares of 2.5 billion, and EPS of around $47.60. Apply a 22 times earnings multiple, and you get a 2030 share price estimate of about $1,047 compared with the current price of 669 DEX. That is about 56% upside, or roughly 9% annualized before dividends. That is a solid return, but it is not some insane upside case, and I think that's important. Meta is a high-quality company, but the stock already reflects a lot of that quality. So for investors, the base case is not, this stock doubles easily. The base case is more like, this can still compound at a solid rate if the business continues executing and AI spending produces enough return. Now in the bull case, the upside gets much more interesting. The bull case assumes AI spending really pays off. Meta improves ad targeting, increases engagement, expands business messaging, monetizes AI assistants and tools, and controls Reality Labs' losses better than expected. In that scenario, 2030 revenue reaches $460 billion, net margin improves to 35%, net income hits $161 billion, share count falls to 2.42 billion, and EPS reaches about 66.50 cents. If the market gives Meta a 26 times earnings multiple, the stock could reach around $1,729. That would be about 158% upside from $669. But to be clear, that requires a lot to go right. AI needs to become more than just a cost center. It needs to become a revenue driver, a margin enhancer, and a competitive advantage that shows up clearly in the financials. That is possible, but investors need proof over time. Then there is the bear case. And I think the bear case is important because it is not a disaster scenario. Meta does not need to collapse for the stock to disappoint. In the bear case, revenue growth slows, capex stays high, regulatory pressure increases, Reality Labs keeps consuming capital, and investors assign the stock a lower multiple. Under that scenario, 2030 revenue is $300 billion, net margin is 23%, net income is $69 billion, share count is 2.6 billion, and EPS is $26.50. At a 17 times earnings multiple, the stock would be worth about $451. That is roughly 33% downside from the current price. So the downside case is not that Meta becomes a bad business, it is that Meta remains a good business, but the market realizes the returns on AI spending are not as attractive as expected. That is a very different kind of risk, and it's probably the main risk long-term investors need to understand. Now, in terms of what I would be watching going forward, the first thing is Q2 revenue guidance. Meta guided for Q2 revenue of $58 billion to $61 billion. If they can continue delivering strong revenue growth, that supports the idea that the ad business remains healthy. Second, I would watch ad impressions and average price per ad. This quarter both moved in the right direction. If that continues, it becomes stronger evidence that AI is helping monetization. Third, capex guidance is huge. If Meta raises capex again, I would expect investors to react negatively unless the revenue growth is strong enough to justify it. Fourth, free cash flow matters. Operating cash flow is great, but shareholders ultimately care about what is left after capex. If capex keeps rising faster than cash flow, the earnings numbers may look better than the actual cash generation. Fifth, Reality Labs losses. A $4 billion quarterly loss is still very significant. Investors will want to see whether that loss stabilizes, shrinks, or keeps dragging on consolidated profitability. And finally, regulation management warned about active legal and regulatory matters in the US and Europe, including youth-related issues and scheduled US trials that could result in material losses. That is not something investors can ignore. So when I put this all together, my read is that Meta had a very strong quarter fundamentally. Revenue growth was excellent, the ad business was strong, margins were impressive, the core apps remain extremely profitable, the balance sheet is strong, but the investment debate has clearly changed. This is no longer just a story about a high-margin, asset-light advertising platform. It is now a story about a high-margin advertising giant making one of the biggest AI infrastructure investments in the market. That can be very good if the returns are strong, but it also makes the thesis harder to underwrite. At today's valuation, I would describe Meta as fairly valued to modestly undervalued. I would still lean bullish because the core business is so strong, and the early signs from ad pricing and impressions are encouraging, but my confidence level would be medium, not extremely high, because the capex risk is real. The key question is not whether Meta is a great company. The key question is whether Meta can turn massive AI spending into durable revenue growth, better monetization, and attractive free cash flow per share. If it can, the stock can still work very well over the next 5 years. If it cannot, Meta may remain a great business while the stock delivers much more average returns, and that is what I'll be watching most closely from here.